Welcome, everybody, to the ARMR Report, the week in review. I appreciate you guys spending some of your Saturday with me, getting ready for stock market action next week. So this is the ARMR Report. I'm sharing with you the ARMR investing way. I'm Brett Rosenthal, and this is a three-stage process of managing capital successfully. What we're going to do today is break it down into three segments and then get to your Q&A. First thing we're going to do is talk about the practical uses of the information flow from the ARMR Report. And we're going to apply it to what we've been doing and what we're going to do next week in the equity markets. Then we're going to go over our portfolio, the ARMR portfolios. We have 4 of them. So I'll share with you what they look like today and what they may change into next week, what's at the top of our whiteboard, so to speak, of how we'll put capital to work. Then we'll wrap up with a quick education piece on how to trade VIX successfully. Okay, we had a monster week last week trading VIX, and we expect, or we're hunting for, a parabolic move that's coming in VIX. And so we're going to be on it both from a core investment holding and also a day trading piece around that core. I'm going to show you how we're doing it and give you some thoughts. Perhaps you can do it on your own as well, or join us and do it with us. So as always, don't forget what we're doing here is I'm sharing with you my own personal experience. I got 35 years doing this. I manage my own personal capital. So, of course, make your own decisions, due diligence, risk tolerance decisions, all those types of things. It's always up to you. If you find this conversation helpful, you can always subscribe right down here. But what really helps, if you really think this is a worthwhile conversation, go share it. Let's fill up our virtual hedge fund trading floor with like-minded individuals who can bring information together as a community. And I kind of feel like we're a community of Davids and we're fighting the Goliaths of the institutions. So if we all work together, we can overcome. Go ahead and share it if it's something you find interesting. All right. So the first thing I want to talk about, and I want to do this every single Saturday. How do we use the ARMR Report to make money, protect capital? But that's the key to all these conversations, whichever ones you end up watching on YouTube or anywhere else you get your information. So really, how do you use the information to make money? That's the question. So we're going to walk through real quick a timeline of how we're managing our own capital and what may happen next week. So the first thing I want you to look at is this. Okay. It's the S&P 500. Now, we talked about this head and shoulders the last couple of weeks. So how do we use the ARMR Report to make money, to protect capital? We start with the Risk Monitor. Risk Monitor has 7 algorithms written for each of the 7 big indexes we follow that for us encompasses the whole market. It's the 4 obvious big ones, the S&P, the NASDAQ, the Dow, the small cap. Then the secondaries, momentum and value, which are the yin and yang of the market, and the IBD 50, which is our representation of the innovative growth stocks. Okay. So when all 7 of those indexes are speaking the same tune, confluence we call it, confluence is king on our desk, that's the institutional Goliath footprint telling us where the institutions are going. And if we can get ahead of those footprints, we can walk alongside those footprints. But most importantly, if we can make sure we don't get stepped on by those footprints, then we can have a successful time managing our own capital. So what we do is we put together a risk monitor for you. Simple, right? Red, green, yellow lights. That's all. So on the 11th, and let's go look at a close-up view of what that means. I share it for you in color coded to make it easy for you to follow, all right? Green here, market rallies. We go to yellow, telling us there's something wrong over here. We get red right at the top of the market. Market craters, green and yellow again. We try to put some capital to work. We're happy to do it. Hey guys, hey, I'd rather be a bullish guy just like you, right? But there are times to recognize when the Goliath footprint is stomping on the BFTD investors. BTFD investors, right? The holders right? The Goliath is stomping on that guy right now. We don't want to be that guy, right? So the risk monitor goes back to red right here. Right here. Yellow, green, we'll give it a shot if it wants to run, raise our stops, comes back to break even. We're out, market craters. Now, what's more disturbing to me is really the weekly chart pattern. That's always the most important. And you just can't argue with that chart pattern. There's nothing you can do to put lipstick on this pig. And so how do we use the ARMR report to protect capital and make money? What's the practical use of the information? The risk monitor tells us when things are dangerous in the market. And so the way to handle that, and forgive me, I'm getting over a cold. I had it all week, so I'll be drinking a lot today. The way we handle that is we have 4 portfolios that we share with you. It's how I run my own money, right? So the index-only portfolio just buys the 7 indexes based on the algos. So that portfolio goes to 100% cash on the 11th of November, missing the entire market collapse. Now, I can't tell you how to run your money, right? What I do is I use all 4 portfolios. I'm going to share with you what a balanced ARMR portfolio looks like in a minute. As a guide, you have to figure out what type of investor you are. The most conservative investor is somebody who focuses on the index-only portfolio. No individual stock risk, no group risk, most liquid asset, most aggressive swing trading strategy. Maybe the rewards will be a bit limited. When you get into a wild bull market, you're going to make money, but not as much as a growth portfolio. But at the same time, you avoid all of the destruction going on in the market today. And you have been since December of last year, when that index portfolio has been pretty much cash the whole time. We've tried a couple of shots on risk monitor green. We've booked some small profits, raised stops. We get stopped out, goes back to cash, market implodes again. Okay. The other thing you could do is we have our ETF portfolio. All we trade is ETFs. So that's a little bit more aggressive, but still no single stock risk. And that portfolio follows the ARMR risk monitor fairly closely. So we're carrying tons of cash there. Then we have our dividend portfolio and our growth portfolio, totally different styles. The growth portfolio, I'm going to leave dividend out for a minute. We could talk about that in the Q&A if you want to. It's a totally different way of running money. It's about building a portfolio that gives you cash, that pays bills. And we really follow a different path. So I'm going to put that aside for now. Let's just look at these other 3 portfolios. So the growth portfolio focuses on individual stocks. That's going to be your highest risk portfolio. You're going to make the most amount of money in a bull market, right? But it's going to be a little more difficult in a bear market. And yet still that portfolio is making money this year. And that's the power of the ARMR whiteboard. How do you use the information? The ARMR whiteboard has been full of commodity stocks because we think this is a commodity bull market. Why do we think it's a commodity bull market? Let's take a quick look. I want to thank Erez for this chart pattern. He put this into the Slack room to share with us. Commodities to equity ratio. Just a basic idea of what's going on. All right, we're right here. Okay, so if you could read this, this is the Nifty 50 of the 60s. Commodities to equities, right? Then you went into the 70s bear market and commodities skyrocketed versus equities. So this is a combination of equities going down and commodity prices skyrocketing in the 70s. Don't forget the 70s for a minute because we're going to look at another chart in a second that I think you're going to find interesting when it comes to helping us understand the type of year we're in 2022 and how we want to position portfolios. So you can see here, this was the Gulf War. So really, this is energy prices going through the roof. Then during the tech bubble, nobody cared about commodities during the tech bubble, right? So the ratio is heavily skewed to equities, right? Then in 2008, peak oil hits, financial crisis. So that's a combination of the S&P collapsing and peak oil, right? And look where we are now. Look where we are now. The commodity super cycle hasn't even gotten started. That's why our whiteboard's full of commodity names. So how do you use the ARMR report to make money and protect capital? We protect capital with the algorithms. We make money with the whiteboard. We focus on the right names. We're making money this year as the market's imploding. Now, I want to show you another chart that I found really interesting on Twitter here. All right, so here's my Twitter feed. If you follow me on Twitter, at Brett Rosenthal, you can follow me on Twitter. Take a look at this. We could look at this real quick, but actually, I don't want to look at the fangs yet. Hold on a second. Take a look at this chart here. Okay, worst performing first 82 days. The first 82 days of the year, going back to 1928, this is the third worst performing first 82 days of the year. So what I find interesting is the other times, 1932, 39, and then look at all the 1970s, 70, 73, 77, 74. Okay? I find that really interesting. There's two things about 1940s in there, 1942. So we have two things about the past that might enlighten the future and what we're dealing with this year. This is the third worst performing. What's similar about those other years? Well, I'm not predicting World War III, but I will say that the market was afraid of, and it ended up being true, that World War III was coming. So you see 1933, 1939, 1940, 1942. Terrible starts to the year. And there's something very strange going on in the Ukraine. I don't know what that's going to turn into, but clearly that's a part of this terrible start to the year. But the more important thing to me, maybe it's not more important, but equally important, is all of the 1970s, right? The 1970s were the time of the commodity super cycle. Inflation out of control, Fed behind the curve. Does this sound familiar to you about what's happening today? Right? And then I go to this other chart I thought this was an interesting chart because this is the first time we've seen it. Look at this. FANG revenue, real growth of the FANG stocks is now negative. It's negative. Google, Netflix, Apple, Amazon, and Facebook have negative revenue growth. Put a nail in the proverbial coffin. And then juxtapose that with where commodities are. The great rotation has started. This is the year of the commodity bull market. So how do we use this information to make money when we look at a chart like that, which is a weekly head and shoulders? And if you want to, say, well, that's just the S&P. Okay, let's take a look at the NASDAQ. Oh my God. Total annihilation. How about the small caps? Oh, they're headed into the abyss. This is the abyss down here. It's over. Massive top. So how do we use the ARMR report to protect capital and make money? First thing we do is the risk monitor, top down, protect capital. It told us to protect capital. It's been telling us since December. We have our 4 portfolios. So if we use a blended strategy, we've been carrying a lot of cash. Then we use our whiteboard to capture upside. And we're focused on commodities. You can see why. We're going to focus on commodities all year. But what happened last week put us into an 80+% cash position. We're somewhere around 85, 90% cash, depending on the type of portfolio. Okay. That was before this week. Take a look at what this week looks like. Just to remind you again. Let's go look at, let's just finish on the S&P again. Okay. So before this collapse week, last week, the week before was risk monitor red week. So we went to cash, dramatic amount of cash for the ARMR report portfolios before the market collapsed, right? Finished off that cash position this week here on the implosion, totally sidestepped the collapse this week. Okay. That means we got lifted out of all of our commodity positions. Not this week, the week prior, we got lifted out of all of our commodity positions. Just because we believe this is a commodity bull market doesn't mean there won't be vicious sell-offs. When the overarching picture is a bear market, which is what that chart pattern is, you've got to protect capital first, capture upside second. That is the core value of the ARMR report. So I'm asking you right now, if your portfolio does not have significant amounts of cash, if you haven't protected yourself, if you're looking at significant losses, then why aren't you a subscriber? And I'll stop right now. I'll give you a minute. I'll take a drink. There's other subscribers watching right now. They get it. They get it. They're already subscribers. They already join us on the live trading desk every day. They join our virtual hedge fund. We share this type of information in the community, and we're a bunch of Davids beating the Goliaths. Why aren't you a part of that? That's a question I've got for you. I'm going to give you a second. You can go over right now. You can go subscribe, not just to this channel, but to the ARMR report. It's ARMR Report. Hey, maybe you don't know what it is. Take a look. Maybe what the problem is for those of you who are still thinking about, gee, what do I do? Maybe I should, maybe I shouldn't. This week should have sealed the deal for you, right? You should be absolutely have decided, that's it. It's time to be an ARMR Insider. I got to be ahead of the game, right? So here you go. I'll give you a second. And I'm sure the other ARMR subscribers don't mind. Here, it's armorreport.com, ARMRreport.com. All right? Join us. Decide to be a subscriber. And you could be in a position right now where your net worth is up for the year instead of getting buried. Now, I know you're going to say to me, well, I've already been buried. What do I do now? Hey, you got to start somewhere. Don't worry. Don't worry. The market's going to give us another opportunity to make money. It's going to happen this year. So now let's go talk about the ARMR portfolios and how we're going to do it. Okay. The risk monitor will go green again. When it goes green, what we do is we go to the whiteboard. First of all, it goes green, and on that day on our trading desk, we're loading up on the indexes. So the index-only portfolio, which has tons of alpha, right? Because when we sit in cash and the market's imploding, we're building alpha. So it makes it easier and easier to put money to work because the alpha is huge for us as the market implodes and we've got cash. Then we get a risk monitor green. So what? We go put money to work. We lose some money. So what? It's easy. We put the money to work. We have a stop as the low of the day we bought it. It goes down the next day we get out. It can happen. It happens. The ARMR algos are not neural networks. They're not crystal balls. They're probability algorithms. And they may be right 80% of the time. And that means they lose money twice. So we have to put capital to work, use our stop. When you have massive alpha, it becomes very easy. This is what it was like in 2020. The market was plummeting down 50%. We had unbelievable. We had 100% cash in the index-only portfolio from February 24th. So when we got the risk monitor green in late March, how tough was it to put money to work? It wasn't. It was an easy decision. Put the money to work. Had a huge year. It's going to happen again. So the index only will go fully invested. Then what we'll start doing is filling out our portfolio. So we'll use the whiteboard to do it for the growth portfolio. It'll be full of commodity names. We spend our time on the live desk listening to conference calls, talking to management teams, doing research together, sharing information, getting ourselves ready for that next risk on green signal. And let me tell you, our whiteboard's full of names like, for me, like my favorite, for as an example, is EP. Oops. It's full of energy companies, okay? I think the energy stocks are going a lot higher. So let's go back to a daily chart for a second. Okay. This company had blowout earnings, and it's going to just keep grinding higher. They're going to have a great year. That's just one example. There's so many. I'm not going to go over them right now. And the reason I don't want to go over them is for me, I don't know about you, but for me, if I get too excited fundamentally about a story, I lose perspective on the bigger picture of the market, and I run out there and buy things too quickly. So I don't want to talk about an individual stock and should I buy it today. We are at the literal precipice of a market implosion. And I hope all of you watching who've been watching the ARMR Report for a long time, I know ARMR Insiders at least, we're all in a position to deal with that. Now, the way I'm going to use the ARMR Report coming out of the next risk monitor green signal, how I'm going to build my portfolio, is to really, I'm going to be taking a more conservative approach coming out of the next risk monitor green. I think that we're at the beginning of a major market decline. I think there'll be a series of rallies off of the lows as tends to happen. So we might get some risk monitor greens along the way. But I think that the mind-numbing, soul-crushing sell-off of the innovator stocks last year was a precursor to what's going to happen this year to the rest of the market. It's like the 1970s all over again. The Fed's behind the curve of inflation. They can't prop up the market. They have to start jacking up rates. The market's going to decline aggressively. So if I get risk monitors, and this is the, let's go over this, call it portfolio changes. Okay. What are the portfolio changes going to be? Right now, the portfolios are something like 20+% cash with one major position, and that's VIX. And I'm going to go over step by step why in a second. We have a core position in VIX, and we're day trading it aggressively. I'm going to go over that in a minute. But what would get me to change that portfolio, and what would I do? The risk monitor will go green. I'm going to focus my capital for a balanced portfolio, right? Like I have my own personal capital I'm sharing with you, but I also manage money for individuals. So in this cycle, which I think will be a difficult market all year long, until such time as the Fed says, we're done raising rates and we're going to start adding liquidity again. Okay, that's different. I mean, if the Fed did that next week, if the Fed says, hey, we're going to jack up 25 basis points and start adding liquidity, or that'll be our last rate hike and we're going to add liquidity. I mean, if the Fed starts saying that, forget it. This whole conversation is moot. The market's going to go up and we'll be buying everything in sight. Okay, but assuming that's not going to happen, and assuming that the Fed is stuck between a rock and a hard place, they can't add liquidity, and they have to keep raising rates because inflation's gone berserk. All of their protestations of, oh, it's just transitory. It's just transitory. Remember that? Remember all last year? Oh, inflation is just transitory. Oh, my God. It almost reminds me of Ben Bernanke telling us that there's no financial crisis in 2008. January, February 2000. There's no financial crisis. Shh, don't worry about it. All the banks are fine, Ben Bernanke told us. January and February 2008. 2021, all the Fed members would come out and tell us, it's just transitory. Don't worry about inflation, right? So now they're way behind the curve. I'm off on a rant now. So let's get back to how to make money with the ARMR Report, right? Portfolio changes. Next week, I suspect no changes. We are large cash position trading VIX. I reserve the right to change that. If you want to find out how I'm changing it, join us on the desk. I will be live streaming the second play-by-play action of the Fed meeting and how we're going to trade it, how we will be doing it, right? So as things change, I'll change. But as of right now, there's nothing the market's going to do next week so on change us. So we're going to work on a whiteboard, get ready. When it happens, we'll heavily weight indexes to stay safe in this market. Try to capture an upswing, but stay safe. We'll overweight ETFs versus individual stocks because we don't want the individual stock risk. Our job is to get on the right side of the right side of probabilities when rewards worth risk. That's very hard to do in this market because the risk of being wrong on an individual stock is annihilation. And the reward is tiny. So the next risk monitor green signal will get me into big indexes and ETFs more so than stocks. But stocks that I do buy, and I'll be buying things off the whiteboard. They're going to be commodity related. All right. So now let's hop over to ARMR Education. I want to walk you through the volatility trade that we're on. And it's just been a monster trader for us. Okay. Now I'm going to go over VIXY. You can use any asset you want connected to volatility. I just like trading VIXY. It's very liquid. I know some of you asked me about UVXY, which is a leveraged ETF, or the calls on VIX. You could do anything you want. For my money, I think VIX is volatile already. It's already ridiculously volatile. So I don't need leverage. I don't need options. I could just buy this ETF and make money. It's liquid. It makes me feel more comfortable. But whatever you want to do, it's all fine. Take a good look at this chart. Okay. Take a good look at this chart. Now, what I'm telling you right now, why we're focused on VIX. First of all, VIX hasn't even gotten started yet. It's just stuck in a trading range. So what I'm about to tell you could be totally wrong and will not really trigger until we break out of this range. Okay? But I'm looking for a runaway VIX at some point in this market decline. I saw something very interesting. You know, Spot Gamma is one of our favorite sources of information on options related details. And they put out a piece today about how there was not really a big showing yesterday as the market was imploding, down 4% on the NASDAQ. What was it, 1,000 points in the Dow, whatever. There was just not a lot of put buying. There was not a lot of put buying. Now, what does that tell you? Well, what it tells me is that is a paw print of the bear. And Goliath is sitting on top of that bear, riding it, okay? The institutions were dumping stocks on Friday. They were dumping stocks all week. It was not options-related panic. That's what that tells you. That's a real bear market. So what I want to show you is this. VIX is trading in a range. See this green bar here? That's when we started buying VIX, right in here. We have a core position on VIX, and we've been trading it every day intraday, successfully, actually making some really good money. But what I submit to you is at some point in here, there's going to be a gap out of this range. We're going to wake up one day, I don't know, maybe it's Monday morning, where VIX is trading at $24 at the open and it closes the day at $25, $26. If that happens, the parabolic move has begun. And we're looking at an opportunity on a VIX of making something like 4 to 5 times on our money in a month or two. Here's an example of what I mean. Now, I know this was a pandemic. Okay, this is the type of move that you see when VIX really gets going. So when I say to you that we're in the business, and I'm just going to show you this chart right here. See, so VIX was trading in a range. Look at this. Right? VIX was trading in a range. You can move it down. Right? And you could go like this. Give me a parallel line. Okay, so just like we are today, VIX was trading in this range. And then something triggers to gap it out. Something triggers to gap it out. And you go on a parabolic run. And what I submit to you, I don't know what that will be that will create that parabolic run, and it may not happen. Who knows? Maybe we just get a typical bear market driven by institutions getting out of the market, and you get this, slow moving train wreck, and VIX never skyrockets. I don't know. But my job is to get on the right side of probabilities when reward's worth the risk. The reward is enormous if we get this trade right. And so what I'm doing on the desk is I'm day trading around the core. I have a core position. Let's just say I have 5% of my net worth in VIX. It goes up 4 times and my whole portfolio is up 20%. I mean, I'm not trying to be a hero here, but let's be serious. We're up 20% by the end of the year and the markets are down huge. We've had an unreal year. And that's just with 5% of my position on. And then what I do throughout the day is I jack up that position size to maybe 15%. Maybe I triple it. Maybe I get as high as 20%. Maybe I quadruple it intraday for intraday trades. Let me go show you what we're talking about. This is how we trade VIX. I'm going to give you I'm going to give you a couple of examples. Here's a bad day in VIX, right? Gaps down, rallies up, sells off. We were buying VIX right here on this day. So we take a core position, which we were losing money on, and we increase the position dramatically here, and it rips higher into the close. And we take that dramatic size off, and we carry our core position, making this whole day pretty much a neutral day. Even though VIX was down big, we actually had a neutral day because of our intraday trading technique, right? Then yesterday, and let's just blow this up and we'll just go over it. Actually, I wanted to show you another trade. This was a great trade. This was one of my favorites from this week. So these are a couple of trades we did this week. This right here is one of my favorites. This was a classic ARMR reversal trade. It's a classic ARMR reversal trade right here. The asset collapses on volume. The volume spike is this green dot. When it reverses and goes above the high of that dot, we get long. So if you're joining us on the trading desk, if you're watching us trade live, I'm talking you through. I said, this just happened. We have 5 day trading triggers we use. We look for locations. When we get to the location and we get one of the triggers, we put the money to work. The stop is the low of the bar we're buying, which is small. So the reward to risk is phenomenal. Okay. This was the bar we were buying. When we were buying it, as it cleared this top, we were buying it right in here, right? Skyrockets right up to our target, which is the average true range high of the day. This blue line right here. Booking profits in here and getting stopped out as it comes back down. That's one example of how we traded around the core. So we're holding a core position, but we jack up the size, double it, triple it, make money on the day trade, hold the core position to the end of the day. All right, now let's see what we did on Friday. Let me see something. This is interesting. Oh, yeah. Oh, this is so much fun. Now, this is where spot gamma comes into play. All right. I'm going to show you the spot gamma location. This is beautiful. So you hear me say I use spot gamma information a lot. Here's one trade. You only need one trade of spot gamma and you pay for the subscription for the year, or multiple years. Same thing with the ARMR report. I'll be honest with you. But spot gamma offers great locations. The ARMR report offers how to trade those locations. And that's why we're real synergistic with spot gamma. But in this case, 19 was the key gamma location on VIXY, which is this white line. Notice how the asset gapped up, comes right down to it, stops, reverses. So there was an entry point right here in the morning, right here, right off of the gamma location, runs up, pulls back, makes a higher low near 19, a little bit higher. And this is where the ARMR report dramatically increased our size of the trade. So if our core position, as an example, was 5% of our net worth, maybe we were up to 20% right here. The stop would have been taking out these lows would have been the stop. Write this down. You'll be a much better trader if you do this, okay? The low of the bar you bought should be your stop. The best trades never challenge the low of the bar you bought. Try it. Go back and look at your trades and see if it would have helped you. This was the bar to buy. It never goes below that bar. We have a massive position size on here. And the stock, of course, there's another entry point right here. So I trade it throughout the day. It pops up. I book some profits. It runs back up towards the ATR. I book some more, comes back, holds. These black dots are the volume weighted average price. Comes back and holds it. I re-up the whole position. I put the whole position back on, and then it just ripped all the way to the close. I always book a little bit at the ATR, so I took some off here, and then I just let it run, and right up to the close. Okay? So those are some practical ways to use the ARMR report to create alpha in your portfolio. The risk monitor will protect, so you have cash, there's alpha. The whiteboard will focus us on the right groups, that's commodities, so there's alpha. The day trading, using the ARMR algos, can create a cushion around a core position, making it easier to hold that core. That's a way to create alpha. Those are the ways to use the ARMR report. Thanks for listening. Let's get to your questions. All right. JJ asks, it's hard to know what's truth anymore. It's a good thing the U.S. isn't producing oil. There's a lot in there. I'm not exactly sure. There's a question there I can answer for you, JJ. I think that terrible, I don't want to get into politics here, okay? But while I can appreciate the desire for planet-saving technology, I'm also a practical person and recognize that those technologies en masse aren't going to be here to make a dramatic effect for probably the next 5 or 10 years. And that was true. It was like 5 or 10 years ago when, or maybe 5 years ago, when you started to really see this urge, of the world to force the world to change to EV technology, suppress the price of energy. And what happens, this is just the bounce back effect of that. It's the reality check that while it's beautiful and altruistic, it's not realistic. And so I don't know if there was a suppression scheme to not produce energy. It wasn't, the price of energy wasn't there to make it worthwhile. And there was a whole bunch of hurdles put up in this country that wouldn't allow, you can't build a pipeline, you can't do this, you can't do that. So now, you reap what you sow is what's going on right now. So again, I'm happy to move towards a more planet healthy environment, but I think we all have to think practically and logically before we try to scream at the top of our lungs that humans are awful and the whole world it's going to collapse because of humans. But let's move those people back to the margins where they belong, and let's manage our society in a way that makes sense towards a common goal. Wouldn't that be nice? Is that even possible? Maybe Elon can help us do that. So this was a question I got through email. Stan wanted to know the best technical indicators to identify a market bottom. Stan, I just wanted to ask you, Stan, I love you, brother. Was that like a softball question? Because the correct indicator to identify a market bottom is the ARMR risk monitor. That's the correct indicator. So thanks for asking that question, Stan. Look, I know what you're really asking. And for those of you who are trying to learn technical analysis and in the world of indicators, there's hundreds of them. Over the decade or so of writing algorithms and working on the risk monitor, there's one thing I can tell you with a fair amount of certainty. it doesn't really matter what indicator you use. There's no one indicator that's the secret sauce. It was a combination. The ARMR algos are a combination of indicators. There's nothing special in there. What's special is coming up with the optimization for the asset you're looking at, which is different from asset to asset based on volatility. And again, creating confluence amongst the indicators. So you've heard of stochastics and MACD, moving average, convergence, divergence, and you've heard of the directional movement index. These are some of my favorite things. Some I use, some I don't. These are some of my favorite things. But really what I look for when I create my algo to come up with risk monitor, red, green, yellow, is confluence across the ones that worked best for me as I was working on them. Some are repetitive. The relative strength index, I mean, that kind of works like the stochastic. So what you're going to discover is if you use too many indicators, you're just going to get lost in the minutia. It's a wasted effort. Find the ones that speak to you, optimize them, and then cross-reference them with others. And when they all line up, bing, that's your best opportunity to look for a bottom. And at the end of the day, recognize that they're not infallible. They're not crystal balls. If you don't marry that with a sound stop-loss discipline, you'll get buried. So those are my thoughts on that front. Net Sky, good morning. How are you? Gilead stock. Let's take a look at your calls from last week. Alibaba had a nice move off the bottom. Good for you, man. Nice little pop off the bottom. Maybe there's something there that's more than just a couple of days. Yeah, I like the Gilead story, but, I look at Gilead, it's just wildly underperformed all of its peers. It's wasted money right now. So you want to pick up the dividend, I get it. But they're starting to come after the dividend stocks, and that's dangerous. They wrecked AbbVie. This was our trade here, and we actually got out of AbbVie at the end of the day on Friday, booking that profit from up here. Our stop was the 50-day moving average, and it gapped below it, so nothing you could do about that. And we are out at the end of the day, having booked a solid gain in AbbVie. But I show you AbbVie only because, and let's take a look at something else. Yeah. See, I told everybody at the ARMR Report, shared it in the Slack room during the week, that I had sold all of my utility stocks. I think I shared that. I think it was Monday morning. I think I did this Monday morning. So this is Friday, Thursday, Wednesday. So Monday. Yeah. Okay. So utilities were up here, and at the open Monday, I dumped all of my utility stocks. Now, I've owned those utility stocks for a couple of years, so I had large capital gains that were long-term, and I'd been collecting dividends the whole way through. I think it's dangerous to own a stock right now just because it's paying a dividend. When interest rates are going up like this, and you're getting the 2-year note, was it close to 3% now? At some point, like for instance, there's a lot of utilities that yield 3%. So theoretically, why don't I just buy the 2-year note? Because that's a safer asset and I can get the same yield. That thought process is going through the minds of every institutional money manager. I guarantee it. And there's going to be a level at which, and it might not be 3%, it could be 4%, it could be 5%. I don't know. There'd be a level at which short-term rates get, right? And there's no point in owning Gilead and collecting a 4% yield when I can own treasuries and collect 5%. If you're only owning Gilead for dividends. You see what I'm saying? Now, if you're telling me there's some huge growth opportunity, okay, there's an opportunity. There's a reason why you would own Gilead instead of treasuries. But we're in a massive bear market with a huge head and shoulders top that's in the process of accelerating lower on a weekly basis. Be careful about your dividend portfolio. We've been raising cash in our dividend portfolio, and we're not adding anything at the moment, so that the dividend portfolio is starting to stockpile cash. Because we could set ourselves up for a decade if this market gets as ugly as I think it's going to get. We're going to get unbelievable rates. on dividend stocks. And the next risk monitor green signal, that's when I want to put the money to work. Right now, I want to husband the cash. Good morning, Tech Monkey. PSLV worth considering? Would it be better by physical? No. If you want to own silver, I think spot physical gold is the right way to do it. I don't have to buy the coins themselves. I'm not a conspiracy theorist to that degree that I think spot physical is not real. I think it's real. It's audited 4 times a year. It's you can get delivery of the silver bars if you want after holding it for a year. So, but that chart just looks awful. And if you go look at the weekly chart, it looks even worse. So I don't own silver right now. I still own spot physical gold. And that, as you can see, that looks better. Spot physical gold looks a lot better than silver. It's just at the bottom of the uptrend here. I might double that position soon. Natural gas. Ultra short natural gas? You're going to short natural gas? Oh boy, I wouldn't short that pattern. But good luck on that one. I'm not sure. I don't need to make that kind of money. I am much more conservative with my capital than that Sky. Much more conservative. I'll day trade the commodities, but I'm not taking a position. I'm certainly not shorting. Now, look, if we wake up on Monday morning, and there's some type of ceasefire resolution in Ukraine, you're going to make a fortune on that short. But that's just like gambling. That's like literally going and gambling. I mean, there's no way to predict that. So I can't get on the right side of probabilities and statistics, and I don't think the reward's worth the risk. So I can't put money to work there. Jason, how are you, brother? Thanks for all that engagement on Twitter. I always like chatting with you and hearing what you're thinking. What do I think about? Don't know it. Have to do some research on it. Never touch penny stocks. Hate penny stocks. And let me tell you something else very interesting. So you talk about the OTC pink sheet penny stock. Did you know Vanguard has stopped allowing all of their accounts to buy OTC penny stocks? We have an ARMR subscriber that was in there saying he used to always do that. He got this letter saying that they're not allowing the purchase of any of those assets. I think Vanguard is very smart asset manager, and they see total destruction of investor capital going on right now in the small cap space, in the innovator space, in the penny stock space, and they don't want any part of it. They don't want any part of the litigation that's going to come from it as this bear market gets underway. If there's a bear market in the big indexes, the last thing you want to do is mess with penny stocks. I never like penny stocks, but if you're ever going to do them, you do them when the Fed's adding liquidity and reducing rates, and then everything starts going up. Hey, Stephen, excellent. So you're using the ARMR report, as Stephen's an ARMR Insider, and you're putting the information to practical use and getting the results you need. That's all. I mean, that just warms my heart, I'm so glad to hear that, really. That's great. KC, thanks for that, brother. Glad to have you in there doing it with us. And that's right. What Casey's referring to is sometimes what we'll do is we'll get long the S&P. So if I got a huge cash position on, and the market's down in the morning and sets up a possible buy trigger using one of our 5 triggers, I'm going to get long the S&P every single time because I come into the day with cash, tons of cash. So from a day trading point of view, if I get a long entry point with the market down, I'm just going to try to capture that alpha. And if it fails, if it hits my stop, that's information. That's telling us something's wrong with the market. So at the same time as that's happening, we're getting a risk-on buy signal in VIX. So load up the VIX position, and you make more than enough money on the VIX trade for whatever small loss you might have with a tight stop on the S&P trade. And then there's some days in there where the S&P skyrockets. I missed it this week. I'm so biased to the negative side that I missed that trade this week. Some ARMR insiders got it because I showed you that, right? I said to you guys, this is it. I should be buying the S&P here, and I didn't do it. I mean, the market was up huge on Thursday. But I'm always looking for that alpha capture trade. So upcoming week, I'm not buying anything in this upcoming week. I mean, I see Southwestern Gas. I've got my list of natural gas stocks and energy E&P companies, KC. So there's a lot of names on the whiteboard. I'm going to want to own these. I'm not buying these things right now when I'm staring this type of breakdown in the face. This is the type of a breakdown that can accelerate down, and it will take every asset down with it. I don't care. I don't care if it's an energy stock. When the market implodes, the proverbial baby gets thrown out with the bathwater. And then we swoop in, and we buy our energy stocks. So that's what I'm waiting for. And guess what, Casey, as you know, sometimes I'll miss it. There'll be some I miss because it won't work out that way, and they'll go up without me. And that's just the way it is. I err on the side of protecting my capital first, and then I try to capture the upside. Teladoc. Festeroso. Teladoc is it's just unbelievable what's going on in that stock. And I'm afraid, as we were talking on the live trading desk, we were talking about, Kathy Wood is becoming a verb, and that's just so sad to see. I don't know how she gets up in the morning and continues to talk about how great Teladoc is. Talk about a person who has zero respect for capital. Kathy Wood has zero respect for capital. I find it unbelievable that she has the high profile ability to raise a lot of money and run portfolios. I can't believe she still has a job. And by the way, you heard it here first. Okay. Market down. The ARMR report said it. The innovative stocks will bottom when Kathy Wood is out of a job and or we stop seeing her on CNBC, which is kind of like the same thing. They'll just stop talking about her. I've seen people like this before in my career. They make a call, they make their name, and the investing public, they love heroes and they love to, take down heroes. So they create these heroes, not because they're intelligent, not because they actually know something, but because they ride the right wave, right? And they don't recognize that they're riding a wave. And when the wave is done, they crash up on the beach. It happens over and over again. I remember in the 1980s, Elaine Gazzarelli. Anybody remember that name? She was brilliant, right? Because she had this basically rudimentary, crude type of algorithm, right? Before anyone wrote algorithms, that told everybody the stock market was going to crash. And it did in 1987. She told everybody the market's going to crash. And then it crashed in 87. And that poor woman, they trotted her out. Every single time CNBC wanted a soundbite about a bear market, they would trot out Elaine. I mean, she made her name. I think she was at Lehman Brothers at the time. Then she left Lehman, and this is when Lehman Brothers had a good name. It was a respected company. She left Lehman, started their Elaine Gazzarelli, whatever fund, raised a bunch of capital, and started managing money. And they would just trot her out every time they wanted a soundbite on a bear market call, right? And so, of course, she was wrong over and over and over again, and then nobody cared about it anymore. Everyone forgot about her, and she was wrong over and over because after '87, the plunge protection team was created, which outlawed market crashes, right? So you can't call another crash if you have the Fed coming out buying the market every time it starts going down. So now we fast forward to the other side. And everybody pretends that Cathie Wood's like some brilliant, oh my gosh, she's so smart. Really? Was she really smart? I guess in certain respects she was. She started a fund and got on some really great names right at a time when the Fed started adding massive amounts of liquidity. I mean, she did it beforehand when the Fed was adding liquidity. And then the Fed really added massive amounts of liquidity. She made a fortune for everybody. Then I guess she believed either her own bullshit and, just kept, these stocks are going to go to the moon and the market's wrong, or she had zero stop loss rules. Zero, which I call a complete lack of respect for hard-earned capital. I work too hard for my money to watch it implode and then come on TV, come on YouTube and say to you, yeah, the market's got it wrong and I'm buying more of it. That's just ridiculous. I don't even care if it ends up going up at some point. It's already ridiculous for the average investor, for the investor who needs to protect their capital, retire on that capital, even if those stocks come back a decade from now, which is what she's saying. Oh, 10 years from now, they're going to dominate. Oh, thanks for nothing. What if people have to retire tomorrow? I mean, come on, it's just ridiculous. Let's move on. All right. Okay. If the Fed pivots again after the next, do you see any risk of hyperinflation? I do see that. Less sauce. I do see that. I love these titles. And this is why one of my only positions that's remained in the portfolio is spot physical gold. And I do think there's the potential for those macro guys to be true, to end up being right. But to be fair, those macro guys have been, singing that same tune for years, maybe decades, right? So those guys have always called for hyperinflation. Dollar loses the reserve currency. I mean, they always talk about it. So broken clock, one day they might be right. I happen to agree with them, but you don't hear me talking about it all the time because it doesn't make us money and it doesn't protect capital. If that hyperinflation happens, if the dollar starts to lose reserve currency, hey man, I'll be all over commodities. I'll be all over precious metals and we'll make a ton of money. But we have to read and react to what we're getting. And right now, what are we getting right now? This is the chart of the dollar. That doesn't look like an asset that's losing its reserve currency. That looks like an asset that's more of a reserve currency than ever as the world is running into US dollars as a safe haven. Yeah, I hear the Weimar Republic story. I'm just saying I've been a gold investor, just so you know. I've been a gold investor on and off since 2005, okay? So I know this story, and I don't disagree with it. But at the same time, I fell in love with this story, and it made for a really ugly 2011 for me. Okay, I'm keeping it real here. I don't just tell you things, wow, I make money all the time. No, I don't. I had a terrible 2011 because I was in love with the precious metal story and I didn't stop my losses correctly because of this macro story. And I regretted it, right? And I swear I'm never doing that again. That was probably the beginning of what turned into the ARMR Report, 2011. And that frustration. And I said, I can't ever do this again. I can't force my will or my opinions of some macro bigs, blah, 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 on managing money day to day. There's got to be a better way. And there is. It's the ARMR investing way. protecting capital, capturing upside, not forcing our will in the market. Understanding these macro stories is important, though. So if we see it unfold and we see the right patterns and we use our algos, we're going to be long commodities. We're going to make a lot of money on that. Ooh, boy, that's a good looking chart. I got to write that one down. Boy, VRNT, that's a nice pattern. Good call on that. I got to do some work on that. I'll listen to the conference call next week, try to figure out why that stock looks so good. So I just wrote that down. Thank you for that. Oh, thanks for that. I appreciate it, Lyle. Oh, without a doubt. Oh, without a doubt. We're not just, oops, sorry about that. We're not just a day trading platform. This is something I really have to make more clear on a website, I guess. And we're working on a new website. So it's going to be ARMR Report 2.0. Over the next couple of months, you'll see it come out. And we'll address this issue. But to be very clear, the ARMR Report is not a day trading website. We day trade. We use that to capture alpha and protect capital during the trading session. Our live trading desk, which goes on all day, is not just about day trading. During that live trading session, we listen. Let's say next week, for instance, the Fed's going to be meeting. We'll be listening to that Fed meeting live, and I'll be doing play-by-play, sharing with you how it's going to affect my trading, how it's going to affect my swing trading, my position taking. We listen to conference calls, and I break down for you what I'm hearing on this. Here's the Facebook call. Here's what I'm hearing. That's a disaster. Got to sell the stock immediately. We're doing that while it's happening. Okay. So, that was not the recent call, but call before. I'm just giving you an example. Like we do that all the time. We had large positions, for instance, in the uranium stocks. Okay. And during the trading session, as it was happening in the morning, I was sharing with everybody, this is not right. There's something, as an example, there's something seriously wrong with this stock. Okay. So it's a swing trading position. We bought it here. It ran up here. It's reversing. We're selling it right here as the trading is going on. And we share that information from a swing trading perspective, from an investing perspective, and from a day trading perspective. So anyway, see if it works for you. Let's go Rangers. Hey, I can't wait. Rangers in the playoffs, and they're looking good. With Shesterkin in net, you never know how far we could go. That guy's unbelievable. Where's the damn button? Where's the damn button? I don't know what that is. Oh, sorry, bottom. Trying to get over this serious head cold, and I need glasses. Where's the damn bottom? It's not here. It's not yet. Out of Verizon, off of our spreadsheet this week. I don't know what's going on with Verizon, but I can't hold a stock that's doing that. And anyway, the stop was right in here, right? When it took out these lows, we had to get out of the position. So on a weekly level, it closes below there, and something's seriously wrong. Lumentum. I mean, at some point, those names, maybe I buy them back when this market finds a bottom, but I can't own them right now. Live, is that in the Live Nation? Yeah, Live Nation and EXPE. Well, see, Lena, these are great ideas for, that looks terrible though. That looks like it's about to break down to me. So that's trouble. But these are great ideas for the whiteboard. These are the travel stocks, the go out stocks, all that kind of stuff. I get it. Marriott and Hilton. I think we were looking at those the other day. How they do on Friday. There's Marriott. There's Hilton Worldwide. So clearly those type of stocks are holding up better than the market, but they don't find their way into my portfolio now, as I know you understand as an ARMR Insider. But we can keep them on the whiteboard. We'll put them on. I know EXPE is on my whiteboard. I like that idea. All right. If I'm entertaining a commodity super cycle, higher inflation, then does this mean tech growth stocks will underperform the coming years? Stan, man, I try not to make predictions about years because I have no idea, how things are. It's hard enough to predict, what's going to happen next week, much less years. And I find predictions are just deadly for managing money because your ego gets in the way. Then you start to believe yourself. And God forbid you're right on a prediction. So now you just think you're infallible. And now you're just setting yourself up for the big fall. So I don't know. How long. I certainly wouldn't guess how long it will take before growth stocks come back. It seems to me the cycles nowadays happen a lot faster than they did in the 1970s. So this whole thing could be over by, the 4th of July. I don't know. You could crater and then the Fed starts adding liquidity again. It's impossible to figure that out. Yeah. SARK makes a lot of sense. The opposite of ARK funds. Wow, they're having a run, aren't they? All right, guys, listen. This has been unbelievably fun, and I appreciate your time spent. I'm just exhausted, and I got to go relax a bit. So, hoping to completely get over this head cold by Monday. I'll see all of you Monday morning for the live morning meeting, 8:30 for all ARMR subscribers. Everybody else, I wish you nothing but the best of weeks, and I hope you have a great weekend, everybody. And remember, while you're trying to make your investment decisions on when to commit capital, how to commit capital, we are at the beginning. We're staring into the abyss of a significant bear market, like a soul-crushing bear market. I've been talking about that since December of last year, and it's just getting worse. And then we'll get into that phase where it's just soul-crushing, because since December we've made money in commodity stocks, so there's places to make money. But when the bear market really starts to get underway, it's just soul-crushing. There's just nothing to do except for hold cash, be defensive, day trade, quick swing trades maybe, but be careful right now. How to use the ARMR report to protect capital, capture upside. Right now, what you want to do is protect capital first. We'll capture upside later. Okay? Have a great weekend, everybody.